Now let's talk more about how bonds are looking for 2023. Let's bring in Bill Campbell from DoubleLine Capital. He's a portfolio manager focusing on global bonds. And Bill, maybe talk just in general. There's obviously a lot more yield out there right now than there was a year ago in the world. Is it worthwhile to try and capture it here, or is it more risky? Do you think yields can go higher still?
Well, Mike, thank you for having me. And what a year it has been, especially in the bond markets. As you've mentioned, central banks have really been the big story as they've been chasing inflation mostly throughout the year. As you know, inflation has really been the pace car for where yields have gone, which has been straight up. So 2022 is now behind us, and we're taking a look at 2023 at DoubleLine, and what we're seeing is a much more interesting bond market outlook as far as potential returns, and we always start with the carry. And I think there's no question that the yields that we're getting at the beginning of 2023 are much more attractive than they've been for the better part of a decade. With the aggressive hiking that we've seen and the backup in yields across all international markets, I think bonds are, needing to be reconsidered as potential place both that not only hang out, but even make some money in 2023. Now, we think that near term, markets, especially, all markets, bond markets, equity markets are going to remain volatile. And that's because the growth outlook is now challenged. What we saw in November is potentially what was the peak in CPI across developed markets and, globally, including international and emerging markets. Potentially we've seen, the near-term peak in CPI, which may allow for a pivot of central banks in the near, over the course of 2023. But at least the stance of central banks going into this year or this coming year is much more aggressive and much more hawkish. We saw the ECB, hike and announce their QT plans for the coming year. Starting in March, they're going to be looking for active reduction of the balance sheet by 15 billion, and that's on top of increased issuance. So near term, really the pace setter of yields going higher over the past month actually has been coming out of Europe. Now, if you take a step back and look out across the year as a whole, we do think that the higher yield and the potential for banks eventually pivoting on slower growth and slower inflation is going to present a very attractive outlook for investors, not just in U.S. markets, but looking at international markets and emerging markets, as far as their bond allocations for 2023.
Bill, you mentioned that inflation, should it continue to decline, would create the opportunity for the Fed and other central banks to pivot to a more dovish stance. But are the markets correctly priced right now for the likely outcome? I ask because many people are focusing on things like, the two-year Treasury yield is above, the upper end of the Fed funds rate range. That is typically implied that the Fed was due to pause. In other words, that maybe they're in danger of going too far. We actually have, an investor survey Delivering Alpha did that said essentially a plurality of investors say Fed should stop right now. Maybe that's not a plausible option with CPI still at high levels, but do you think there is a risk that they're over-tightening already?
I think that, that risk is front and center. And, the biggest risk, obviously, is to growth. Central banks not only are raising interest rates, but they're reducing their balance sheets, and that's tightening global liquidity. We're seeing M2 actually flat on a year-over-year basis when it's been positive for, much of the past 3 decades. And all of this is a risk to growth. And it's been, actually, I don't think in the U.S. we've seen a hiking Fed into a falling growth outlook scenario when we take a look at the leading economic indicators, which puts together a lot of the economic indicators for the U.S. That's actually turned negative on a year-over-year basis. And when we look internationally, not only in the U.S. but across the globe, the majority of manufacturing PMIs are below 50 or in contractionary territory, and most central banks are still on a hiking path. So I think the bond markets are correctly interpreting that this tightening of central bank policy to address high inflation is going to have a growth impact, and that's why we see yield curves inverted not only in the United States but in many developed and even emerging market countries, with the 10-year below the 2-year, suggesting that central bank policy has gone a little too far and is risking a bigger growth correction. Which, by the way, if you get a bigger growth correction, that's not only going to help pull CPI lower, it's also going to help yields rally as well. So on top of the attractive yield that you can get a nice yield rally, across bond markets. And then also one item to consider is when central banks pivot. We have started to see a little bit of correction in the dollar, but currencies will likely rally against the dollar in the second half of the year, on a more aggressive central bank pivot that, first, in the beginning of the year, if you're, a little bit more aggressive investor, we do think currency volatility is likely to stay due to the challenged growth picture. But the second half of the year, I think there could be a second very interesting trade for an international allocation that if you're a long-term investor, these, are fairly attractive, currency rates to get in at.
Mm-hmm. Yeah, for the first time in a while, potentially, Bill. Appreciate it. Thanks a lot for running through all that with us, and Happy New Year.
Happy New Year. Thank you, Mike.